Everyone, welcome to Diane Vey Finance. I am your host, Diane Vey. Today, I will be going over some things that I found while researching interest rates. And just so you know, I don't typically spend my days looking up interest rates. So, what are they? Why should we care? And just because interest rates may seem boring, does that mean we should just go about our daily lives pretending they don't exist? Maybe they'll disappear in a corner somewhere. Interest rates can impact the prices that you see when you're out shopping at the grocery store or when you're out pumping gas into your car. If you don't know what interest rates are or would like to learn more about them, you might want to stick around and watch the entire video because I will go over a lot of information that is hopefully easy for you to understand, but not before I share some statistics that I came across while researching for this video. In the last 2 months, the Federal Reserve federal funds rate dropped 50 basis points from, I'm guessing, 5.50 to 5%. And the consumer price index dropped 2.4% year over year. According to AOL, employers added 254,000 new jobs to payrolls. And according to the Pew Research Center, Americans owed $1.6 trillion in student loans, about 42% higher than they owed a decade ago, as more people go to college and the cost of higher education increases. Interest rates might seem boring or as complex as rocket science, leading some people to overlook their significance in everyday conversations, especially since they're tied to financial topics like mortgages and loans. And these topics can feel distant for some people who are not in the market. However, interest rates play a crucial role in our everyday lives, influencing everything from personal finances to the broader economy. So understanding these changes is essential, but vary based on individual circumstances. And while interest rates can be complex and multifaceted, grasping these basics is worthwhile because it can help you make informed decisions, reduce debt, and improve your financial knowledge in the future. So I'll go over some common misconceptions people have about interest rates because as I was researching this, I realized I had some misconceptions too. So this is a good way for you to see if you have them as well. And because this is an educational video, I thought it would be appropriate to mention that some of this content was created using ChatGPT. While researching for this video, I had a lot of questions, and there was a point I thought about giving up because it was just a lot of information. But I didn't. Instead, I chose to go over my other sources to make sure that the information that I'm providing you today is as accurate as possible. Interest rates do not affect savings accounts. So some people might think that interest rates don't influence the interest earned on their savings accounts, but sometimes higher interest rates can lead to better returns on savings while encouraging people to save more. And according to Bankrate, for savers, banks offering top interest rates tend to pay more when the US central bank hikes rates and less when they cut them. And online banks tend to compete for customers using comparatively high rates, while brick and mortar banks may not pay as much in terms of competitive yields. This misconception that interest rates don't affect real estate prices overlooks how higher rates can increase borrowing costs, reduce the buyer's purchasing power, as well as the demand for homes. Rising interest rates can lead to lower real estate prices and decrease buyer interest and market sentiment. According to NPR, there are different factors influencing mortgage rates, like the yield on a 10-year Treasury bond, the amount a mortgage lender might need to cover costs while making profit, your credit score, and the size and type of loan that you're getting. Just throwing this out there, the median price home has risen about 50% since 2020, while the existing home sales price was $416,700. As of August, 3% higher than last year. So while inflation does influence interest rates, the relationship is not always straightforward. Central banks may adjust rates in anticipation of inflation and other factors such as economic growth and geopolitical events. Additional factors that may lead to inflation include increased wages, consumer spending, employment, and investments that come as a result of economic growth. During times of high inflation, central banks may raise interest rates to reduce spending and borrowing. Inflation drives up the cost for borrowing as well as the demand for higher interest rates to compensate for a lender's decreased purchasing power over time. This could lead to a reduced consumption and help curb inflation. And during times of low economic growth, they may lower interest rates to stimulate borrowing and investments, which can also drive up inflation. And this is important to understand because inflation may affects many aspects of the economy, from decreasing the purchasing power of the dollars in your wallet and increasing the interest rates you pay to borrow money, to increasing the prices that you pay for food, gas, housing, electricity, and other basic needs. So according to Bankrate, when rates are high, lending is more expensive and the federal funds rate influences the interest rates lenders charge new borrowers. And the federal funds rate affects how expensive it can be for lenders to loan money. So consumer loan rates typically change when the federal funds rate changes, and the vast majority of personal loans are fixed rate loans, which means that the interest rate remains unchanged from when payments begin to when it's paid off. So borrowers with fixed rate personal loans will not see changes to the interest rate or monthly payments as the Fed rate changes. As of September, the average personal loan interest rate was 12.41%. And while interest rates on new loans are unlikely to fall soon, new borrowers can still qualify for competitive rates by improving their credit and shopping for the best deals. According to Bankrate, the driver's rates might depend on several factors like credit history, term length, and vehicle type, just to name a few. And would you look at that? Increased inflation can mean higher interest rates, even for drivers with perfect credit. And according to Bankrate, again, the benchmark rate can also affect the cost of vehicle financing. Now, ChatGPT says a benchmark rate is the standard interest rate used as a reference point for various financial products and economic indicators. It helps set rates for loans, mortgages, and savings accounts, and is often linked to the performance of a specific financial market. According to Bankrate, again, the Fed's interest rate sets the base rate that lenders offer businesses for their loans. So these rate changes can have a broader impact on businesses, like increasing their employment rate, increasing the money supply that's available for banks, businesses, and consumers. Whereas lower interest rates can make it less expensive for businesses to get loans, it could also serve as a catalyst for starting a business, undertaking expansion, or ramping up production. Lower borrowing costs can encourage economic activity, boost the job market, and stimulate the business's growth while keeping inflation in check. So while the federal interest rate sets the interest rates for both fixed and variable business loans, the impact it has on borrowers can be felt in different ways. Existing borrowers with a fixed rate can keep the same interest rate they agree to and pay the same amount. On the other hand, variable rate business loans will have the interest rate with the market rate. This means that borrowers may see their monthly or weekly payments changed with the federal rate. In addition to that, interest rates can impact the annual percentage rate, or APR, as well, as the factor rate or for business loans and lines of credit. The interest rate of a business loan or its line of credit plays a huge role in how much it will cost to borrow money. Another interesting point that I think was brought up in the article was that even when a loan doesn't have an explicit APR or interest rate, the other rates like the factor rate, the flat rate, the weekly, monthly rates are based on the interest rate set by the Federal Reserve. According to Forbes, private student loan rates fluctuate based on market conditions. So people with private student loans, especially people with variable interest rate loans, could see those variable rates go down as the Federal Reserve cuts interest rates. Interest rates on these private student loans are based on a benchmark rate with possibly an additional margin based off of the person's creditworthiness. However, federal student loan rates are fixed from the moment you sign those documents. And since interest rates on federal student loans change once each year on July 1st, any future changes will be for new loans disbursed after that date, but not for existing fixed rate loans. How interest rates can impact personal finances. So when rates change, they affect borrowing costs as well as the interest earned on return on savings in ways you might not immediately notice. And this might be the case for some people who might not understand how interest rates might affect them. Higher interest rates can significantly impact our personal lives in several ways. And they can lead to higher mortgage costs as home ownership becomes less affordable. And they can also affect how much homeowners pay monthly. So people with variable rate loans or credit cards might see larger monthly payments, which can strain their budget and complicate debt management. Higher borrowing costs can discourage discretionary spending, which then affects people's lifestyle choices like dining out or going on vacation. And some people might prioritize building emergency savings, which limits the funds for immediate expenses, but that's not the case for everyone. Higher interest rates might encourage some people to save as they earn more on their savings accounts. However, this might shift their focus away from making investments. So, as you can see, interest rates can influence consumer spending, investment decisions, and the willingness to invest in new projects and expansion, as well as the performance of various economic sectors, which can play a critical role in shaping financial dynamics all across the board. It can also influence our financial habits and our ability to make healthy decisions across different areas of our lives. This relationship is crucial to understanding how interest rates impact consumers directly because it affects the purchasing power of our money as well as the cost of living. Additionally, higher interest rates can slow economic growth, which then affects job security and can lead to fewer job opportunities. Now, here are some real life examples that are frankly closer to home. According to JP Morgan, as of September, the Consumer Price Index or CPI rose 0.2% month over month and 2.4% year over year. Gasoline prices declined 4.1% month over month and 15.3% year over year, whereas electricity prices rose 0.7% month over month and 3.7% year over year. The food index rose from 0.4% month over month and 1.3% year over year. And according to one of the more recent surveys by the Bureau of Labor Statistics, unemployment was at 4.1% with 6.8 million people unemployed and 4.6 million people employed part-time due to economic reasons. And this is as of September. There was also an upward trend in food services, healthcare, and construction and social assistance. Increased interest rates can significantly impact the economy in various ways. And this may lead to higher borrowing costs for consumers, possibly reducing discretionary spending and decreases consumption, which eventually slows economic growth. This can also lead to increased financing costs for businesses, which then affects capital spending, wages, expansion, hiring, and the number of job vacancies that are available. Additionally, higher rates may encourage saving over spending and decrease disposable income due to increased debt servicing costs. This may lead lenders to tighten credit, making it harder for individuals and businesses to obtain loans. Furthermore, higher interest rates can also stabilize prices, but they can also lower stock valuations and create market volatility that may impact retirement savings. And while central banks may raise rates to control inflation, this can also slow economic growth if spending is significantly cut back. Certain sectors like the automotive industry, consumer goods, real estate are especially sensitive to these changes. And a slowdown in these areas can have broader implications for job growth and economic stability. For instance, the housing market often cools as mortgage rates rise, resulting in fewer home sales and less construction activity. This would also affect relevant industries like home improvement, engineering, manufacturing, utilities, and interior design. And I think it's important to highlight some data that was collected by the Bureau of Labor Statistics in one of their establishment surveys. The establishment survey data refers to information collected from businesses and organizations about their employment, payroll, and job openings. Employment in food services and drinking places rose by 69,000. Healthcare added 45,000 new jobs. Social assistance added 27,000. Construction added 25,000. Moreover, higher interest rates can strengthen the national currency by attracting foreign investments, as it can boost demand for our national currency. However, this could make export services pricier for foreign buyers. Interest rates serve different purposes in various financial contexts. I'll be going over some of them with you, as this can help you make more informed decisions. And if this is too much for you, don't worry. You can always rewatch this video. The federal funds rate is the interest rate at which banks and other depository institutions lend and borrow money from each other while meeting their objectives. Then there are short-term and long-term interest rates, which reflect the cost of borrowing money over different time periods. According to the Fed's explained, short-term rates would decline if the Federal Open Market Committee reduced the target range for the federal funds rate, or in circumstances in which the Federal Reserve's communications or an unfolding event led the public to think that the interest rates will drop lower than expected. On the other hand, long-term interest rates are affected by how people may expect the federal funds range to change in the future. Long-term interest rates can affect the prices for a wide range of financial and non-financial assets, like natural resources or real estate. Fixed interest rates are rates that remain constant throughout the life of a loan or an investment, which provides predictability in payments, while variable or adjustable interest rates may fluctuate based on market conditions, potentially affecting monthly payments over time. The prime rate is the interest rate at which banks lend to their most creditworthy customers and is sometimes used as a benchmark for various loans, while the subprime rate is a higher interest rate offered to borrowers with poor credit histories, but this can lead to increased risks. Furthermore, the annual percentage yield, or API, reflects the total interest earned on an investment or savings account in 1 year and includes compounding interest, according to Investopedia. Furthermore, the simple interest is calculated only on the principal amount, whereas compound interest is calculated on the initial principal and accumulated interest, leading to expense. For credit cards, the interest charged on the outstanding balances can mean fixed or variable interest rates, and these are often higher than other types of loans. The annual percentage rate, or APR, includes the interest rate plus any fees or costs associated with the loan, giving a more comprehensive view of the total borrowing costs. The usury rate refers to the maximum legal interest rate that can be charged on loans. This can vary by jurisdiction, and the late payment interest rate is an increased rate applied when a borrower fails to make payments on time, and this is typically specified in the loan agreement. The introductory or teaser rate, aka promotional rate, is a temporarily lower interest rate offered at the beginning of a loan or credit card, and these rates can increase after a specified period of time, which affects its initial affordability. And then there's the discount rate. It's the interest rate used by central banks to lend money to commercial banks, often influencing overall economic activity. Monetary policy. So before we go any deeper, it's important to understand that there are three key entities to the Federal Reserve System. The Federal Reserve Board of Governors, or Board of Governors, is an agency that reports to and is directly accountable to Congress and provides general guidance to the system. It oversees 12 reserve banks from Washington, D.C., and is not funded by Congress. Its operations are financed from the interest earned on the securities it owns, specifically securities acquired from the Federal Reserve's open market operations, and fees received for the services that they provide to depository institutions like check clearing, fund transfers, and automated clearinghouse operations. This income is used to cover the cost of those services. And after everything is done, their net earnings are then transferred to the U.S. Treasury. So the 12 Federal Reserve Banks, or reserve banks, operate independently with supervision by the Board of Governors in the following 12 Federal Reserve districts: Boston, New York, Philadelphia, Cleveland, Richmond, Atlanta, Chicago, St. Louis, Minneapolis, Kansas City, Dallas, and San Francisco. The Reserve Bank essentially acts as a financial institution for the banks and thrifts and credit unions within its district. It's basically a bank for banks, and it offers and charges for its services to depository institutions, similar to how ordinary banks provide services to their customers. Services comparable to checking accounts, loans, coins, currency, safekeeping, and payment services that help banks and ultimately their customers buy and sell goods, services, and securities. Additionally, commercial banks that are part of the Federal Reserve System own stock in the Reserve Bank of their respective district. The Federal Open Market Committee, or FOMC. So, central banks such as the Federal Reserve play a crucial role in setting interest rates to achieve their monetary policy objectives. There are two objectives based on economic conditions, such as maximum employment and stable prices. This is also known as the dual mandate. And the Federal Reserve does not act alone. The Federal Reserve acts basically requires the Board of Governors and the Federal Open Market Committee to develop a monetary policy that meets those objectives I mentioned seconds ago. The FOMC is made up of the Board of Governors and Regional Federal Reserve Board presidents. They meet throughout the year to review how the economy is going, analyze risks to employment and inflation, authorize monetary policy, and see how the country's money supply is being managed. During these FOMC meetings, the committee sets the federal funds target rate cited in its dual mandate called the Fed rate, which then sets the outlook on the state of the economy, which then affects interest rates. The FOMC directs the Federal Reserve's operations in foreign exchange markets and authorizes currency swap programs with foreign central banks. So remember when I mentioned open market purchases, the Federal Reserve System has many monetary policy tools for policy implementation like open market purchases, and the open market desk at the Federal Reserve Bank of New York conducts them. Discount window lending is a backup source of liquidity for depository institutions and serves as a useful tool for promoting financial stability, providing temporary funding to banks that are experiencing liquidity pressures. Purchases and sales of securities is another tool. And now, would you look at that? There's interest rates administered by the Federal Reserve. And then there are lending tools like emergency lending programs that rely on the Federal Reserve Act. This allows the Board of Governors to establish broad-based lending facilities in unusual and dire situations, but with the approval of the Secretary of Treasury. I also wanted to show you how interest rates have changed over the years as they reflect the economic conditions and monetary policies over the last 16 years, because I think it will help us understand the times that we're living in. During 2008 to 2014, the Federal Reserve adjusted the federal funds rate by cutting its target from roughly 5% to nearly 0%. During this time, the Federal Reserve expanded its lending to banks experiencing shortages in liquidity. Dollar equity swaps with several foreign banks were arranged to address global dollar funding pressures. Dollar funding pressures refer to the challenges that institutions, businesses, and governments face in the process of obtaining US dollars for financing, trade, or transactions, particularly in the context of international markets, foreign banks, and transactions. So over this period, we saw what happened in 2008, followed by the American Recovery and Reinvestment Act of 2009. From 2015 through 2018, the federal funds rate goes up from nearly 0% to roughly over 2%. Why? The economy was expanding during this time, and the labor market conditions looked like they were improving. At this point, the FOMC began reducing the size of its asset holding in late 2017, and the Tax Cuts and Jobs Act passed that year. In 2020, the FOMC lowered short-term rates to nearly 0%. Since 2020, we have seen people lose their jobs and also saw the GDP dip. The actions and programs introduced during this time were targeted to support the flow of credit to households, businesses, nonprofits, and municipalities. The Federal Reserve took forceful measures using open market operations to restore market functions, taking actions to improve liquidity conditions in short-term funding markets. They facilitated a flow of credit through programs in coordination with the Treasury Department. And banks were also encouraged to use their substantial capital and liquidity buffers built up over the past decade to support the economy. It was during this time that the committee noted that it was looking to achieve inflation averaging 2% over time. Fast forward to now, according to Bankrate, during their meeting in September, the FOMC decided to lower the federal funds rate from somewhere around 5.50 roughly to around 5%. And now people are speculating that it will drop another 25 basis points after Election Day. Never thought I'd use this phrase in this context, but do you think they'll make the cut? The FOMC is scheduled to meet on Wednesday, November 6th, and Thursday, the 7th. And as I was putting all of this together, I thought about something that I read earlier by the International Monetary Fund, or IMF. They've been observing things like 2020, the weather, and geopolitics. And starting today, we are literally going to see newly elected governments enter into office, along with the possibility of shifts in trade and fiscal policies that will follow. Financial stability, in its most basic form, could be thought of as a condition where financial institutions and markets are able to support customers, businesses, and communities, even in a stressed economic environment. In other words, it depends on the financial strength of firms and critical financial market structures and their ability to manage volatility while continuing to provide essential products and services to consumers, communities, and businesses. Demand shocks affect spending on goods and services as they can come as a surprise and can influence the economy in ways that may seem uncertain. Some examples may include consumer and business confidence and unexpected changes in credit standards that banks and other lenders may apply when they consider making loans. Because this type of information is not always readily available, it can take some time before a demand shock is identified and the FOMC responds to it. So the policy actions today may take several quarters or more before their effects on spending and inflation take hold. In conclusion, interest rates are a critical component of personal finance and the economy. They have a profound impact on our personal financial decisions, from saving to borrowing, investing, and spending. And by understanding the different types of interest rates, their relationship with each other, how they're determined, we can make more informed decisions. I know this was a lot of information, but what stood out to you? And if you knew this information sooner, do you think it would have made a difference? And is there anyone that comes to mind that you think could benefit from this information? I'm also looking for video suggestions. So if you have a suggestion, please type it below in the comments. Thank you for watching, and I will see you in the next video.